Every central bank loves the word stability. They promise calm seas, steady prices, predictable exchange rates, and a world where nothing surprises you too much. For years, that was the sales pitch of modern monetary policy. Trust us, and nothing dramatic will happen to your money. So in 2011, when the Swiss franc was rocketing higher and threatening to crush the country's exporters, the Swiss National Bank made a bold promise to the world. It drew a line in the sand and said, in effect, we will not allow the euro to fall below 20 francs. Not today, not tomorrow, not as long as we can help it. For more than 3 years, that promise held. Traders treated 20 like bedrock, like a concrete floor under the EUR-CHF exchange rate. You could lean on it, you could trade around it, you could build business plans on it, write contracts against it, and sleep at night, assuming that one small country's central bank would hold back the tide of global capital. And then, on a random Thursday morning in January 2015, that floor disappeared. In minutes, one of the calmest currency pairs in the world started moving like a penny stock in a panic. Lifetimes of stability evaporated between coffee and lunch. People woke up in one financial reality and went to bed in another. This is the story of how a cap became a trap. For a central bank, for traders, for businesses, and for anyone who believed that a line drawn by policy was stronger than the tides of reality. Collapse does not always announce itself with fireworks. It is not always a stock market crash on the front page of every newspaper. Sometimes collapse is simply a promise that quietly stops making sense and then stops being honored. To understand how Switzerland ended up in that position, it helps to start with a comforting idea that sounds harmless, rational, almost protective. We'll just put a floor under the exchange rate. We'll stop the franc from becoming too strong. On paper, it sounds like insulation. In practice, it creates something much more dangerous, a one-way bet. After the global financial crisis of 2008, the world lurched from banking panic to sovereign debt crisis. The Eurozone became a laboratory of fear. Greece, Ireland, Portugal, Spain, each headline carried the same subtext. Government promises might not be good, banks might not be safe, currencies might not be solid. When people lose trust in their own system, they look for an escape hatch. For many Europeans, that hatch was Switzerland. The Swiss franc had spent decades building its reputation as a safe haven currency. Political stability, strong institutions, conservative monetary policy, and a small but rich export-driven economy gave it an aura of reliability. When the rest of Europe shook, the franc barely trembled. So as the euro crisis deepened, investors did what investors always do when they're scared. They fled toward perceived safety. They sold euros, bought francs, and pushed the EUR-CHF exchange rate lower and lower, closer and closer to parity. What looked like strength on a chart felt like a chokehold inside the Swiss economy. A watchmaker in the Jura Mountains suddenly realized that the same watch priced in euros brought home far fewer francs. A hotel owner in Lucerne watched bookings from Germany and France dry up as a weekend in Switzerland became more expensive than a week elsewhere. Exporters found that their products, once competitively priced, now looked grotesquely expensive in foreign markets. The qualities that made the franc an object of admiration abroad turned it into a source of pain at home. Savers loved it, exporters despised it, and in an export-heavy country, exporters usually win the argument. So on September 6, 2011, the Swiss National Bank stepped in. It announced a minimum exchange rate of 20 francs per euro and declared that it would enforce this floor with utmost determination, buying foreign currency in unlimited quantities if necessary. In simple language, the SNB promised that if the euro ever fell toward that line, it would print as many francs as needed and buy euros until the rate moved back up. The floor would be defended, no matter what. For Swiss exporters, this sounded like oxygen. For currency traders, it looked like a neon sign flashing free insurance here. A floor in an exchange rate does something very specific to market psychology. If EUR-CHF trades at 125, and everyone believes 20 is unbreakable, betting against the euro is suddenly less attractive. Your maximum possible profit is capped. On the other hand, betting on the euro feels safer because your downside seems limited. If the price falls, the central bank is supposed to step in and push it back up. A policy that was meant to stabilize the currency created a concentration of risk. Volatility did not disappear, it simply got stuffed into the edges of the system, compressed against that 120 line. The SNB believed that the threat of unlimited intervention would scare speculators away. For a while, that expectation looked justified. The exchange rate hovered eerily close to 120, like a plane flying just above the minimum altitude, never quite touching the floor, but never drifting far from it. To the casual observer, it looked like perfect control. Inside the central bank's balance sheet, a very different story was unfolding. Every time fear returns to the Eurozone, flows into the franc intensified. every time EUR CHF drifted toward number 1. 20. The SNB had to do the thing it had promised: print more francs and buy more euros and foreign assets. What started as a defensive maneuver became a habit. By 2014, the SNB's foreign currency reserves had swollen to a staggering size relative to the Swiss economy. The central bank was sitting on a mountain of foreign bonds, equities, and other assets. On paper, it looked rich. In reality, it was highly exposed. If the euro weakened, the value of those reserves would fall when measured in francs. Mark-to-market losses started to dwarf what most people think of as normal central bank fluctuations. Public debate intensified. Had the SNB tied the country's fate too tightly to a weakening euro? At the same time, to discourage capital from flooding into francs, the SNB drove interest rates deep into negative territory. Deposits at the SNB were punished, not rewarded. The message was clear: parking money in Switzerland would cost you. This is the paradox of a safe haven. When everyone wants to be inside your walls, you sometimes have to make the inside less pleasant just to keep the gates from being crushed. But even that was not the central bank's biggest problem. The real pressure came from a different institution in a different city, the European Central Bank. By late 2014, the ECB had decided the Eurozone needed stronger medicine. It was preparing for full-scale quantitative easing, a campaign of massive bond purchases meant to push down yields and weaken the euro. Imagine the position this put Switzerland in. One central bank was doing everything it could to keep the euro from falling too far against its currency. Another, much larger central bank was preparing to do almost everything it could to push the euro down in general. It was like trying to hold up one end of a table while someone else was piling weight on the other end. Markets could see what was coming. The more clearly the ECB telegraphed its intentions, the more investors believed the euro was destined to fall. And if the euro was destined to fall, everyone knew exactly where the pressure would show up. At 1.20 in EUR to CHF, the line the SNB had sworn to defend. The floor stopped acting like a safety feature and started acting like a magnet. Capital pushed against it, testing it, leaning on it. The more the euro weakened elsewhere, the more strain accumulated on the Swiss defense. That is the moment when a cap becomes a trap. A policy tool that once bought time and stability becomes a cage for the institution that created it. To maintain the floor, the SNB would have had to expand its foreign currency holdings even more aggressively, printing francs on an ever larger scale and absorbing a currency that another central bank was actively trying to cheapen. The balance sheet risk mounted. Domestic criticism grew. Quietly, in boardrooms and in late-night conversations, the same questions must have repeated themselves. How far is utmost determination supposed to go? What does unlimited intervention really mean in practice? And what happens on the day when continuing is worse than quitting? On January 15th, 2015, those questions found their answer. Without warning, in a brief and clinically worded statement, the SNB announced that it was discontinuing the minimum exchange rate of 120 per euro. There was no grand countdown, no gradual widening of the band, no polite gesture toward those who had built their assumptions on that line. One moment the floor existed, the next it did not. Markets reacted with the vicious speed that only suppressed volatility can produce. EUR CHF plunged. On screens around the world, traders saw quotes flicker and vanish as liquidity dried up. In some places, the rate briefly printed levels that seemed absurd for such a historically calm pair, the franc's suddenly worth dramatically more against the euro than it had been just minutes before. For anyone whose finances were tied to that exchange rate, reality flipped. The damage radiated outward. Forex brokers who had offered retail clients tight margins on what they assumed was a relatively safe pair watched as client losses blew straight through account balances. Some brokers went bankrupt. Retail traders who had held leveraged positions on the assumption that the SNB's floor was inviolable found themselves with wiped out accounts, and in some cases, debts instead of savings. Swiss exporters woke up to find that their products had just become significantly more expensive in euro terms. A euro-denominated invoice that once translated to a predictable number of francs suddenly brought in much less. Households in Eastern Europe who had taken out mortgages in francs, attracted by lower interest rates years earlier, saw their repayments explode when measured in their local currencies. All of that pain was compressed into hours because of what came before it. The floor did not just protect people while it existed, it encouraged them to build on top of it. It gave the illusion of a hard boundary in a world that does not have many. When that boundary disappeared, all the risk that had been kept quiet, all the volatility that had been held in check, came roaring back in a concentrated burst. Markets do not respond as violently to uncertainty as they do to broken certainty. A vague risk that something might happen is far less dangerous than an assumption that something cannot happen, right up until it does. Why did the SNB pull the plug? The official answer pointed to sustainability. The euro was under intense pressure. The ECB was about to flood the system with liquidity. Defending 1.20 20 indefinitely would have required the SNB to vastly expand its positions in a currency that its own issuer was trying to weaken. The cost was not just financial, it was political and structural. There is a point at which a central bank must ask whether its own policies are compromising the very autonomy it is supposed to protect. The Swiss authorities chose a sharp, painful break over a slow-motion entanglement. From their perspective, it was a necessary escape from an increasingly untenable position. From the perspective of those who trusted the floor, it felt like a betrayal. 3 years of utmost determination had conditioned people to believe in a world where one won, but 20 was as solid as the Alps. On that morning, they discovered that the line was not carved into stone, it was written in policy ink. The deeper lesson lies beyond Switzerland. Fixed exchange rates, floors, caps, bands, pegs, these tools appear again and again in financial history. They are introduced to tame volatility, to buy time, to provide reassurance, and again, they follow a familiar pattern. At first, a promise of stability calms markets. Trade stabilizes, capital flows adjust. People begin to treat the promised level as a fact of nature. Over time, positions accumulate around the artificial boundary. Businesses price goods and services as if they will always be there. Traders design strategies that assume it will hold. Households take on debts that only make sense if the peg survives. Then, reality shifts. Economic conditions change. Political patience wears thin. The cost of defending the line grows heavier, but the world outside still believes. Eventually, pressure reaches a point where continuing is no longer feasible, and the promise is abandoned. The very thing that made the policy attractive in the beginning, its apparent certainty, is what makes its end so violent. Those who trusted it most are often those who suffer the most. The Swiss franc floor is one case study in that wider pattern. It shows how a small country, famous for caution and prudence, can still end up trapped by its own promise. It reveals a simple but uncomfortable truth. When a central bank tells the world it will fight markets indefinitely, the markets eventually ask to see the receipts. For individuals looking at this from the outside, the story offers a set of quiet, practical lessons. First, every financial guarantee is conditional, whether anyone admits it or not. A bank deposit is safe until the day it is not. A pension promise is reliable until the day it gets restructured. An exchange rate is fixed until the policy maintaining it changes. The assumption that they would never let that happen is not a risk control strategy, it is a vulnerability. Second, artificial stability often hides, rather than removes, volatility. When prices are held in a narrow band by decree, pressures build at the edges. The day the mechanism fails, you do not get a gentle adjustment. You get all the postponed volatility at once. Third, depending on a single authority's promise is very different from depending on a broad, decentralized reality. A diversified portfolio of assets, currencies, and income streams rests on many pillars. A single peg rests on one. There is also a psychological lesson. Humans crave simple lines. This is safe, this is risky, this is guaranteed, this is not. A central bank that offers a floor uses that desire. It draws a picture of a world with one less thing to worry about. But history suggests that the most dangerous words in finance are, "This time is different," followed closely by the "Bunyum." This level will be defended. The more comfortable those words make people, the more cruel the eventual correction tends to be. In the end, what survives an episode like the Swiss franc floor is not the promise itself. It is the pattern it reveals. A cap became a trap when the cost of keeping it exceeded the willingness to pay. A line that looked protective turned out to be temporary scaffolding. The shock did not come from the existence of risk. It came from the belief that risk had been abolished. When the world is told that something cannot move beyond a certain point, it is wise to remember that nothing in markets is truly immovable. There will always be new promises of stability, new pegs, new floors, new caps. They will come dressed in different language, framed as protection, presented as wisdom. The temptation will always be to build on top of them as if they will last forever. But history offers a quieter, more disciplined approach. Respect policy, but do not worship it. Recognize its power, but also its limits. Understand that every artificial line drawn on a chart carries a hidden timer, and that no one will announce exactly when it expires. The story of the Swiss franc floor is not just about Switzerland, or about 2011, or about one surprising Thursday in January 2015. It is a reminder that, in finance, as in life, promises made by institutions are tools, not laws of physics. They can be created, maintained, and abandoned. The more absolute they sound, the more carefully they should be examined. Stability is valuable, but unexamined faith in stability is expensive. History has shown again and again that when a cap becomes a trap, the escape always comes with a cost.